Welcome to the Probus Pleion Quarterly Outlook. I am Marc Staudenmann, partner at Probus Pleion, and it's a privilege to be your host today. Thank you, dear audience, for joining us. Will the US dollar melt further? Is there more upside for gold? Will equity markets go beyond the current all-time highs? And where are interest rates heading to? I believe you joined the right call. I'm absolutely delighted to have two exceptional speakers for you today. It is a great pleasure that we present Marc Syz, the co-founder of Syz Capital. Marc has made a difference at the forefront of investing for several decades. He has spent significant time in Asia before returning back to Switzerland. He is presently the managing partner and CEO of Syz Capital here in Switzerland. Initially, however, my colleague in Dubai, Adrian Kirigin, the Chief Investment Officer of Probus Pleion Middle East, will take us on a journey around the globe. Before we start, I need to cover a few technical points. Please bear with me. I can encourage you to use the chat function for your questions from the very start. This will help me and the team to organize and handle your questions. Thank you. We discuss the global economy as well as geopolitics in a broad way. We'll dig deep into Europe and learn about market segments worth considering. We'll cover macro topics in some detail and share our asset class preferences. However, in order to remain compliant, we'll not be able to share securities advice during the call. Our content is not to be seen as investment advice to you. We don't give investment recommendations to a broad audience. Our presenters state their own views, opinions, and strategies. My colleagues and I will be happy to assist and answer your personal questions and recommend a strategy and investments that fit your personal situation. We want to make sure that our recommendations are meeting your expectations, are within your risk tolerance, and help you to achieve your goals and ambitions. Besides this, we will assure compliance with both our regulations as well as your local rules. With this, let me hand over to Adrian Kirigin, our Chief Investment Officer in Dubai, for his macro update and outlook. Adrian, the floor is yours.
Thank you, Marc, and thank you, ladies and gentlemen, for joining us on this quarterly webinar. I will now share my screen. If you could, can you hear me well, Marc?
Yeah, I can hear you very well.
Okay,
fantastic.
just checking.
All good.
Just great. Okay, let me just share. Please confirm once the screen is visible.
Screen is good.
Okay, perfect. Let's go then. So, as we always do during this quarterly webinar, we'll try to get a sense of where the economy is, more importantly, where it is going, and the implications it has for markets, the various asset classes. Admittedly, it's quite a daunting task when some of the key variables and levers of the global economy are changing in such a quick manner, and as we will see how these have evolved over the last quarter, and more importantly, how they will evolve going forward. So, just to set the stage a little bit, as you recall, during Q1, we had quite a firm narrative that was sort of setting up. We had a US administration that was talking about the need to cut spending, government spending, because the economy had become too reliant on it, and that they were cognizant of the fact that that would potentially lead to a detox period, and that we could see economic weakness. You also had Trump on the other side telling us that you shouldn't look too much at the stock market. So they were basically setting the stage for a shift that was probably the right one for the economy long term, but that was likely to lead to pain in the short term. And now after that, just a few days after our call, we had Liberation Day, and everything escalated even further, where they took the trade policy way too far, and with dramatic implications for market and the economy. Well, just a few days after that, we had a big shift, right? We had Trump basically pivoting significantly on the trade front, but also on the other important element, which is fiscal policy. Fiscal policy has been a very important support for the US economy in previous years, with very wide deficits despite a solid economy. And this is well shown here. You had markets that basically round-tripped very quickly. You can see on the right side of the chart, markets recovered quickly. And you can also see one of the latest comments by Besant. Basically, that what is important is that the economy grows faster than the debt. This is a big shift relative to the initial intention to cut spending, and to basically try to improve government finances. And so the question is, what really happened, right? And what happened is that at the peak of the sort of tariff tantrum in April, you saw that bond yields, which had initially fallen, started to move up sharply, right? Which is the bottom part of this chart. You can see that the bond yields, the 10-year yield in the US, started to rally, to move up, despite risk assets being under pressure. Something that is the last thing you would want to see, right? And this is likely the main reason why it sort of forced this pivot by the Trump administration, as equities kept under pressure. And then finally, around the 8th, 10th of April, Trump started to signal some changes there. The other element is, as I mentioned, that the fiscal side of the economy has also changed, right? You can see on this chart, the lower line is basically showing you that given the current bill that has already passed the House and is likely to pass the Senate, we have a deadline looming on the 4th of July. We'll have to see what type of modifications are, again, done at the level of the bill. But the fiscal deficit is expected to expand in the first few years, with the benefits of deregulation, and private sector growth only kicking in later on. So from Q1, where you had expectations also due to Trump's Musk's efforts to see shrinking deficits, now deficits are likely to expand. So what does that mean? That means that the downside for the US economy is sort of capped a bit, an important fact, reducing dramatically the odds that there could be a recession. Now, on the tariff side, there's also a consensus that has emerged. We've seen that over the last month or so, there's a new sort of acronym that got a little bit of attention in the market called the taco trade, right? Trump always chickens out. Something that obviously is not to Trump's delight, but because most of the measures he had initially announced in a very aggressive manner, he has sort of backtracked on. And naturally, the consensus has formed around that as an assumption. But you can see here from Bank of America's survey of fund managers that the expected tariff is likely to settle around the 10%, 10 to 15%. So basically, markets now are anticipating, and generally people are anticipating, that they will end up being, come July 9, sort of bilateral or universal tariffs of 10%. And then a scenario that is not positive for the economy, but much better than what was initially feared. And maybe that was part of Trump's plan, if he had one. Now, that obviously raises a couple of concerns. Number one, now the assumption is that fiscal policy will remain supported. Number two, that trade policy the outcome will be fairly benign. Now we have deadlines looming on the 4th of July, on the 9th of July for trade. And, again, it is very unpredictable to know what the US administration does, especially Trump. He could easily ramp up pressure again in the short term, but the underlying assumption is that his tolerance for pain was proven to be quite low, right, in April. And that is, of course, supporting in general the mood. Now, the impact of a 10% tariff if we assume that to be the base case, and obviously that seems to be the best case scenario in the current environment, if you look at these estimates from the OECD and GaveCal research, you can see that it is likely to have a bigger impact on the US economy than being a big importer than other major economies, right? You can see the red bars showing you that the impact on GDP, could be, quite sizable if you compare it to the one on the Eurozone, and the impact on inflation as well. So this general, uncertainty around policy, and even that the outcome could end up being 10%, could still have some ramification for trade disruptions, etc. But the importance is that it has really hurt sentiment, right? And this has been the story of Q2. Sentiment has been very poor for consumers and for businesses. Business deals have fallen sharply. Everybody's was a bit in wait and see mode to see what would be the impacts and where would things settle. And for this, we've had quite a sharp revision in growth estimates. You may recall at the beginning of the year, growth estimates for the US were quite high. You can see if we look at the top part of this panel, that this blue bar here, showing you at the beginning of the year, growth estimates were at 2.1. At the end of Q1, they were at 1.9. They currently are at 1.4 in the US. You can see that there's been a shift lower. And you can see, if you look at the bottom bars here, that the evolution of that line has been quite steep. So Q2 has seen a sharp revision in growth estimates. So that tells us that consensus accepts that there could be some weakness in the economy. On the other hand, you see Europe, where actually recently we've seen a little bit of an upward revision in growth estimates. Of course, growth in absolute terms remains quite low, but the second derivative is positive, which is something that is quite noteworthy for general asset allocations. Aside from that, if you look at growth around the world, you see that China has had pretty steady growth estimates, around 4.5. India as well, around 6.3. So the main takeaway, the main change has been really the perception around the US. But the problem is that actually these survey data, the soft data, has been quite weak, but the actual measured economic output in the US has remained resilient. Yes, there was a negative Q1 GDP reading, but that was largely due to a big negative contribution from imports. So likely due to basically demand being front-loaded before the potential implementation of tariffs. So what we've seen is that the actual economic output, be it industrial production or retail sale, which you can see here at the top and bottom respectively, has been good. And so this dichotomy between the survey and the hard data has basically sort of allowed the market to, from the initial fears of a growth slowdown, recover, on the back of the pivot from Trump, on the back of on the trade and fiscal policy. And so now, interestingly, that the consensus is embracing a very benign outlook, we started to see a little bit of a deterioration, right? A little bit of a few months or weeks in a row of weaker economic data coming out, underwhelming data in the US, right? So you see typically that retail sales have been a bit on the weaker side. You see industrial production as well. You see that on the labor market as well. You have jobless claims that are pushing, which is the center part of this graph. You can see that it's pushing the upper end of the range of the last couple of years. You see continuing claims as well, basically making new highs, new cycle highs. So these are not red lights, but it does show that the latest hard data has finally started to point to a little bit of weakness. We also see that in the housing markets, interestingly, that where the data has continued to deteriorate. So this kind of now opens the door to, do we see continuation in that sort of weaker data that could open the door to a soft patch that would potentially mean, rate cuts being materialized in the US. Now, so for the US, the base case right now is that will we see sort of the hangover from the initial front loading of demands that we had in Q1 and early Q2, with now more rapidly deteriorating data. We're kind of on a wait and see mode on that front, because of course it could have implication, or let's say make the the current valuations in US equities a bit harder to justify. Looking at Europe, the main story, and of course we'll elaborate that with our guest today, is really the fiscal spending. We say the end of the debt brake in Germany, and the fact that Germany has embarked on a sort of increase deficit spending spree, if you want. You can see that the debt picture in Germany that was expected, if you look at the bottom part of the graph, to sort of continue to flatline and potentially even lower in the future, is now expected under rare scenarios to increase from a very moderate level, around 65%. And in deficits, which were expected to be sort of expansionary, or rather that there would be a budget surplus, now are clearly expected to be, in deficit for the foreseeable future with significant stimulus packages. This was a main reason for us to remain sort of constructive, on European assets, and this has not changed. There hasn't been really a change. To the contrary of what we've seen in the US with this huge pivot on the trade and policy front. In Europe, the backdrop remains supportive because of fiscal policy being now expansionary, and also, as you can see here, basically loan growth in the banking sector continuing to accelerate, which is also quite supportive for the economy. And the fact that there's been rate cuts is also sort of reinforcing or likely to push this, or to increases the odds of the continuation of these trends, right? So on the European side, we're still quite confident. Then to look at inflation and see what has happened, implications, of course, mostly being on the yield side, we've had a few months of quite soft inflation data, and the main drivers of this, and we can see the US at the top and Europe at the bottom. We've seen really cooling inflation. Of course, if you look at the US, it's still above the Fed's target, but there's been cooling inflation, and it was largely driven by the services side of the economy, where shelter inflation and even services inflation in general have been going down, which is encouraging. And energy, also the energy contribution to inflation, has been quite weak. Now, the big question going forward, and why we think that it's likely inflation going forward might start to tick up, is that in the end, now the goods component of CPI, which is about 20% of the basket, is likely to be influenced by tariffs, right? If tariffs, let's say, settle at 10%, and goods are 20% of CPI, and the US imports about 50% of its goods, a 10% tariff would imply 1% increase in CPI. So far, we haven't seen it. It has ticked up very modestly by 8 to 10 basis points. But this is really the question going forward, and probably why the Fed really wants to hold its rate for as long as possible, although the increased political pressure is starting to see some let's say some dissension within the FOMC. But this dynamic so far has allowed most central banks in the world to keep cutting rates, which is obviously has been supportive. The Fed has diverged that front. Hasn't helped the dollar, as we'll see in a bit. But this is on the inflation side, the message is that now there is a risk that inflation stabilizes and starts to move higher. So as I said, if we look at the left side of the chart, central bank rates, for the Fed, the Swiss National Bank, the Bank of Japan, the ECB, the Bank of England. So the message is quite clear that this year we've had further cuts, right? We had further cuts by the BOE, most notably by the ECB, the gray line here. We had the Swiss Central Bank that brought us to 0%. And obviously the BOJ continuing to be the one that diverges with, rates that have been hiked, not recently, but are likely to potentially move even higher. So now we have a situation where the ECB is likely coming to an end of its sort of cutting cycle. And the Fed is facing this predicament of, Powell doesn't want to appear as yielding to the pressure applied by Trump, and at the same time wants to wait to see what are the effects of this current sort of trade policy on the economy, on the inflation side and the growth side. Now, as I mentioned earlier, we've had a little bit of a soft patch in terms of data, and so now we have, on the one hand, Powell talking about holding rates, but at the same time, a number of other FOMC members trying to make a case for a July cut, probably trying to get Trump's favor by having more of a dovish tilt. The point is that next year Powell is going to be out of the Fed, and that the markets are now likely to start to price that the new Fed member will be very dovish. It has already begun, and that means that future cuts will sort of be priced in, right? So this is likely to sort of, in the meantime, keep a little bit of pressure on U.S. yields. We can see here the top part are U.S. yields, the 2-year and sorry, the 2-year in gray and the 10-year in blue. And we can see that if over the last, over this year, mostly, over the last at least quarter, yields have been very sideways. There's been, these sort of offsetting forces between inflation cooling, growth uncertainties, but growth holding up. And then on the other side, the problem of obviously the deficit being quite wide. Obviously, as deficits are quite wide, especially in an environment where you have less appetite for US assets, you could see upward pressure on the long end. Well, we haven't seen that. It's been fairly range bound. You can see both in the US and in Europe. In Europe, we've had, of course, a little bit more pressure in short yields because they are tied to the central bank rate, which has been cut. But what we think now is basically, if the US growth data is slightly weaker, plus you have the Fed that we have increased rate cuts being priced, you're going to see maybe a bit of pressure, and it makes sense to have the duration up to 4 years in our view, which still gives you blocks some the yield. We still think that the duration side, you don't want to extend it too much, right? Because you still have these excessive deficits in the US. So while we have a little bit of softish data, you want to be, potentially a bit longer on the duration, up to 4 years, but you don't want to go too far, in our view, given that the recession scenario is really unlikely. Now, moving to the dollar. The dollar really has been the casualty this year. We've been holding a negative view on it, and for the time being, we keep that view. You can see that here, the dollar index basically now back in the 2014 to 2021 range. It's down, around 10% year to date. Now we clearly have a very strong, like the consensus has really moved in the direction of being negative dollar. When you have such a strong consensus and speculative positioning, you can easily have some snapback rallies. But we really, for the time being, we still think they should be faded. We have quite a significant sort of a backdrop between the erratic nature of policymaking in the US and, more importantly, the overall positioning of the world that remains very long US assets. We think that the rebalancing away from that excessive positioning will take a long time. It's not a couple of weeks story, and that will sort of keep structural pressure on the USD. Not forgetting as well that the US administration is happier having a weaker dollar. Now, and one of the key reasons behind that is really, as I just mentioned, the amount of money that is invested in the US, relative to the amount of money that the US has invested elsewhere. So if you look at the net international investment position of the US, so basically how much money is invested in the US by foreigners relative to how much money is invested by the US in foreign countries, you can see that there is a negative balance of around $25 trillion. And so as the US administration has this type of policy making and is sort of closing in on itself, this overweight that the world has on US assets is likely to be reduced. Let's not forget that the US is 68% of MSCI world, around that 65 to 70. 10 years ago, it was closer to 53, 55. And for us, this is a trend that is likely to have staying power. And let's not forget that in the Big Beautiful Bill, there is a clause. Of course, this bill has not yet passed, but it has been put in that bill. There's a clause called Section 899, where basically the US has the right to impose substantial taxes on companies, individuals, or entities in general from countries that the US considers are imposing unfair treatment or taxes on American businesses. This is a very arbitrary sort of clause, and that obviously has the attention of big institutional players. This is not the type of dynamic you want to be exposed to, and it sort of reinforces the idea that you might want to maybe adjust a little bit the positioning. Interestingly, what we see since April, since Liberation Day, the larger the imbalance between the investments a country has in the US and the investments the US has in that country, the larger that imbalance, the greater the move on the currency. That suggests that there could be some repatriation or potentially some hedging. A recent BIS article actually says that there hasn't been a lot of net selling, but there's been a lot of hedging. And why would there be, why would, aside from this factor, there's been another significant change in April that is worth paying attention to, is that if you look at historic pullbacks in equities greater than 10%, it has usually been associated with a rally in the dollar, right? So if international investors were comfortable or more confident being non-hedged to US assets because the dollar was providing a little bit of a cushion in case of bad times. And you can see this here, all of these various corrections with the dollar in dark blue and the equities in light blue during these corrections, and you can see the diverging movements, right? Well, if you look at the latest one, you actually had them move in sync. So the dollar was falling at the same time as the equity market. This is a change in correlation that is just one instance, but captures the attention, right? And when you add it to all of the other elements mentioned, it sort of reinforces the idea that these rebalancing flows could continue. Then, if we look at where global equities are today in terms of their performance, despite this sort of turnaround or pivot by Trump, you can see that US equities continue to lag year to date relative to other markets, right? So if you look at the S&P, for example, up 1.4, now it's closer to 3 year to date. When you compare that to the Chinese ETF, 16%, you compare that to the European ETF, 16%. So what this is really telling us is that, yes, we have to acknowledge there's been a nice snapback in US equities, particularly in tech, as we'll see in a bit. But year to date, international markets continue to outperform, and this is still a strong signal in our view by the market. And when you look at global equities outside of the US, they've been going nowhere since 2007. You can see here the index. The breakout that we're seeing here in 2025 is significant. It's, in our view, structural, right? So it means that you really want to be looking more at buying pullbacks in these markets rather than increasing allocation to the US. Now, looking at the earnings estimates, you can see, remember that we had very heavy and high expectations for growth in the US at the beginning of the year. You can see all these bars basically showing you earnings growth in 2024, which is the gray bar, and then from left to right, earnings growth estimates at the beginning of the year, the end of Q1, and currently. And you can see in the US typically that we've had a nice sort of downward revision in estimates from 15% growth to 9%. 9 is still, a little bit on the high end of what we would expect. There's been a nice shift. Whereas in Europe, which is quite surprising, you've also had a downward revision in earnings estimates, which, to our view, given our positive sort of reflation view on Europe, we think that this could be revised upwards, and starting to see a little bit of signs of that. Then, interestingly, to go to the right side of this chart, you can see that earnings estimates in China have actually been moving up, right, from 10% to 22% for the Shanghai Composite, as we get to the market. Now, looking at the US market, the S&P 500, so this recovery was also, to a great extent, aside from the pivots we've discussed so far, was also to a great extent due to the strong recovery in tech stocks, right? And why? You remember in Q1, we also had another factor weighing on the US market, which was the DeepSeek event. Basically putting into question the amount of money large cap tech was spending on AI because of the Chinese ability to, let's say, develop products at much cheaper for much cheaper costs. And we've had tech recovering significantly because the large cap tech stocks have actually done quite well with their earnings and have confirmed their intention to keep spending and to keep ramping up capex. So this has really given a sort of a new breath or new thrust to the sector, which has outperformed in Q2. Now, at this level, we have, what do we have? We have US equities trading at 23 times earnings. We're close to all-time highs. Technically, we have to admit the market continues to look, resilient, strong. First half of July is generally quite strong in terms of seasonality. But now we have a very sort of complacent consensus that assumes that the trade outcome is going to be fairly benign, that the bill is going to be supportive. Two events that could easily, underwhelm. And therefore, at this level, we still think that you're better chasing outside of the US than, chasing in the US. Now, with fiscal policy being a sport, if it doesn't completely turn around in the Senate, you shouldn't expect a big pullback in US equities. We would think during summer, if you have like a 10% correction, it would be reasonable to add a little bit of exposure. Now, noteworthy as well that historically the third year of bull markets is much more volatile than the first couple of years. We are in the third year of the bull market. So, another factor is that from a seasonal standpoint or historical perspective, we should expect, and especially with the nature of the policy, expect to see, a volatility. In Europe, again, as I mentioned, we're quite constructive on the market. We think that pullbacks should be bought. We continue to favor the same sectors we liked at the beginning of last quarter, which are industrials, which obviously contains a bit of defense, and financials. You can see here the sectoral performance in Europe. You have the leader year to date are financials with 16%, and you have industrial companies that are doing okay as well, with around 6% performance, right? Both of which we think have sort of tailwinds because of the elements we mentioned earlier: loan growth in banks. You have the economy that's likely to see reflation. You have, of course, also all of the infrastructure packages, infrastructure spending that's kicking in now in Q3 and Q4, right? So we still like these industries. Couple words on China. Our view remains fairly constructive there. You can see here on the top part, you can see retail sales that have sort of continued to sort of improve recently. It does point to consumers doing at the margin better. We think as well that the support by the government is likely to continue. You can see that basically they've cut loan prime rates, try to support the real estate market further. They've cut short-term rates. They've also cut the reserve requirement ratios of banks, and the consequence of that is you see supportive money supply growth. It's again not the bazooka stimulus we would all want, even though they're probably right not to go in this direction. But at the margin, it keeps supporting the economy. And most importantly, on the trade front, we've had the biggest escalation between the US and China that we could have feared, right? In a very short time frame, China responded in a very commendable manner, showed strength. And as we had argued in the past, the fact that the US realizes that they don't have that many levers to pull with China. Right? China controls supply chain of a number of critical minerals that are also very important for the US defense industry. And this is a big reason probably also why they have sort of backtracked. On the other side, the US cannot really sort of convince or force other countries to form a bloc against China, because as this graph shows, the percent of countries that trade more with China than the US is, as you can see, around 75% or 70%. And the number of countries, or the proportion of countries that trade more than twice as much with China than the US is over 50%, right? So China is a key trading partner. Another factor that, is contributing to sort of this view now that we think these trade tensions are unlikely to escalate as much as they've had in the past. Chinese equities, we remain quite constructive. We think this bull market has, further to run. Here's the China A50. It's been consolidating and, likely to move higher. Finally, in Japan, we've kind of had a neutral view on this market for like a few quarters now. It's been range bound, as you can see, for over a year. You have this dynamic where, yes, it's still, plenty of good reasons to like Japan from, the valuation standpoint, the increased shareholder friendliness, policies, increased interest also by foreign investors, activists. But the issue is that this is the one central bank that keeps a policy that is too loose relative to the environment. And recently they said that they don't think that inflation is structurally above 2% yet. CPI is still around 3%. We think that they will be forced to keep hiking. The yen basically will, keep appreciating. So you want to stay, you can stay long Japanese equities and keep the exposure of the currency, in our view. But one of the key reasons as well is potentially as money is repatriated a bit away from the US and into Japan, there could be increased allocation to equities, from households, etc. So a market that, we want to see an upward resolution, but quite constructive. Finally, in terms of equities, India, which we had pointed out last quarter as being a good sort of entry point for those that didn't have exposure. Since then, we've had a nice recovery. You have a number of drivers that keep sort of supporting this market. First, in an uncertain trade environment, India's trade dependency is fairly low in relative terms. You have the government that is doing the right thing in terms of fixed capital formation spending, trying to improve infrastructure, which is key to absorb all this labor force, 10 million people a year going into the labor force. Still a structural story. Valuations now are, however, back, if you look at the bottom of the panel, back at the average over the last 5 years. Still reasonable to have exposure or to add to exposure in our view. And a key factor, let's not forget, is also that domestic investors keep adding to the market. There's these systematic investment plans. Every month, there are systematic flows going into the equity market in India, from the population. As you can see, the gray bars on the top left, right? These are, and blue bars being foreigners that obviously sold in the panic, but the gray bars show that there's systematic flows from domestic investors. To close, couple of words on commodities. On the commodity side, we had in the peak of the sort of tariff tantrum, we had OPEC Plus come and say, we're going to increase production, right? Or we're going to sort of reduce our production curbs. And the fact that they chose that, obviously the timing was quite important. They've also, since then, reiterated their intention to increase production. It led to sort of this breakdown, right, from this range. As it seems like they're going for increasing market share, and at the same time, it's satisfying Trump, where he wants to lower oil prices or energy prices. Of course, we had the geopolitical escalation that led to this sharp squeeze in oil prices. And on the energy front, in our view, you have a situation where, as long as you don't have, if you have geopolitical tensions, you never know where oil goes. But in a world where they aren't, oil will be weak. You have this sort of supply dynamic that should dominate in our view. So having energy stocks is reasonable because it provides a hedge in case of another deterioration in geopolitical tensions, and they're cheap. But we don't see it as the stronger part of the commodity spectrum. Commodities in general have been sort of a mixed bag. Of course, the stellar performers remain, in the precious metal space. We also have a few industrial metals doing well. Gold here, you can see, continuing on a stellar bull market. The message here is that, it's been driven by central bank, obviously, as we know, as we've discussed many times. And we see that, the retail side of the investment world, which is, as you can see, the bottom part here, flows into major gold ETFs. They've been coming into the market, but you were very far from the type of exuberance you've seen in the past, when gold topped. So in our view, it's basically still a buy the dip. If you go to the 31, 3,200, you want to buy. And then, interestingly, we have other precious metals that have woken up quite nicely. You know, this year you have silver doing quite well. You have the platinum group metals also doing quite well. Other precious metals that have been left for dead that have obviously more industrial applications as well, and also have very specific and interesting fundamental cases. So tactical exposure to commodities remains wise in our view. You still have the prospect of, trade disruptions, potentially a rebound in inflation. You also could have, a re-escalation in geopolitical tension. So still something that we retain in our portfolios. And that is it for me today. Obviously, I would be very happy to have some questions, so do not hesitate. And I will hand it back to you, Marc, and thank you very much for your attention.
Thank you so much, Adrian. That's greatly appreciated. As always, very, very clear. I would suggest we wait with the questions until the end. Let me now welcome Marc Syz. Marc, welcome to Probus Pleion quarterly call. It's an absolute pleasure to have you here. Before we look deeper into Europe, Marc, let's talk about your career in a little bit. You've spent significant time in Asia, and you've then come back to Switzerland. Can you tell us what the key drivers were for that professional decision?
Yeah, sure, Marc, and thanks for having me, and great presentation, Adrian. Thanks a lot for sharing that. So maybe a little bit on myself. I left for Asia back in 2011. Spent most of my career in finance, and most of it in alternative investments. I basically was leading a private equity, venture capital, and growth equity firm out of Asia, managing portfolios for the region. We saw tremendous growth there, and so served, I would say, the beta wave in alternatives for kind of 7-8 years, from 2011 to 2018. And what we were seeing, back in the day, is that we were coming to a point where, as much as alternatives, are put into clients' portfolios to kind of reduce risk, increase returns, according to the good old Markowitz, efficient frontier optimal portfolio theory, there was more and more correlation with traditional asset classes. And this is what kind of, led me to come back to Switzerland for both professional but also private reasons, as I had 2 young kids who were born there, and we wanted them to learn Swiss German, which was not that easy because my wife is Swiss, but she's from the Romandie part. So her mother tongue is French and Italian. And so we decided to come back, start Seeds Capital to really focus more on uncorrelated investment returns, which are basically what alternative investments should be doing.
Absolutely, I couldn't agree more, and it's fascinating to see how many parallels our lives have, Marc. So thank you for that. When you look at you said you basically founded Seeds Capital, amongst other reasons, in order to exploit more uncorrelated opportunities. Has that played out well, and is it still a case that you can exploit?
Yes, absolutely. I think more and more what's happening, especially with the current world, and I'm happy to share a couple of slides if you want. Let me see if I can actually share the screen here.
If you see how, then that works. If not, Marco can back you up.
Let me see if I can. I'm not sure I can actually share. Maybe you can share, but yeah. I don't think I can actually share my screen here.
Marco, can you jump in, please?
But basically, what's interesting, and obviously happy to share those couple of slides and data points later on. But on the first page, which I kind of shared here, we have some interesting data points on volatility, right? And so what you have here basically is an aggregation of volatility, over the past kind of 20 years. which has increased, significantly. So not just in the last months, but over that, time period, and especially the last 5 years. And you can see it here in, traditional asset classes such as equities and bonds. I mean, the bond market volatility has been on the rise. It was addressed also by Adrian before, influenced by, numerous factors, interest rate changes, inflation expectations, and so forth. And if anything, I think what investors have realized is that we have to invest more and more into alternatives to kind of bring that diversification element, but we need to find, alternate sources, of returns to portfolios, as mentioned. And so we strongly believe that looking for, uncorrelated source of returns is the way to go. And more, investors are realizing that. And maybe on the next slide, which is quite interesting, to kind of underpin your question, Marc, around, do we still find this and where can we find that? I mean, here we have, some data points, which are quite interesting, of one of what I consider the world's, best investors, which is Yale University, the endowment fund, which has achieved, an impressive kind of annualized return of about 11% over the last 20 years. And that exceeds, by the way, the S&P 500, which returned about 7.5%, over the same period, but obviously not with the same volatility. Now, Yale has been known for, its strong performance over the long term, primarily due to its diversification into alternative assets, such as private equity, hedge funds, real estate, alongside their more traditional, equities and bonds. And so it showcases the benefits of that diversification and having, that alternative asset exposure. However, and we've realized, especially, in the kind of the last year, but also the last kind of 3 to 5 years, you're seeing those kind of performances, coming down. And that's been a real issue. You see private equity, venture capital, who constitute about, almost half, or I would say 45% of the endowment's portfolio, exposition. There's been huge liquidity concerns and market pressures, and now they're exploring to sell these kind of, 6 billion, of private equity and venture holdings, in order to create that liquidity, because they're just seeing that the returns are not there, the liquidity is not there. And so they're now looking for alternative sources. So coming back to, where do I find these uncorrelated returns? And there's so many, asset classes offering that. The problem is it's not democratized. It's obviously a lot more work, and that's basically where we're looking for. You also see that maybe, and I obviously don't want to bore you with too much data, but on the next slide, we've actually shown a bit of what the evolution has been on kind of a 3-year rolling period of risk-adjusted returns, or you can call them Sharpe-like ratios, who have evolved again for the same endowment portfolio, which is Yale, over the last 20 years as well. And you've seen how they've been basically plummeting. I mean, it's the view illustrates really kind of the relative stability or volatility of each of those strategies, and how that risk to return profile has evolved over time. And what's interesting is to see not only have they all been coming down, and very few have actually been holding up, except maybe for hedge funds, which is quite interesting. And the reason really why I wanted to show you that is to underpin how difficult it has become for even some of the world's best investors, especially if they're sizable, to generate that alpha, and therefore creating that need to explore other avenues. I mean, that's really what this is about. And so obviously Europe is one of the themes we want to look at. But to reply to your question, Marc, this is, I think, where we as investors, I think we have a huge, tremendous opportunity, because we're not as big necessarily, and even Yale is not that huge. They're running about 60 billion. But when you're starting to become extremely large, like the big pension funds and some of the big allocators, it's very difficult to look for huge amounts of diversification and more niche asset classes, which I think investors like yourselves and the investors on this call have the ability to look for.
Fantastic, and I couldn't agree more with you, Marc. It's size matters, but very often I find these days that it's really the smaller, the newer, the less tapped opportunities that create more of an excitement for myself than and nothing against them, the BlackRocks and the KKRs, etc., that are just a huge asset gatherers and the huge houses, right? No, fantastic, Marc. Thank you. Can we turn the page slightly and let's have a bit of a conversation. I'd like to pick your brain about what's happening in Europe at the moment. When you see that Germany is abandoning the debt brake, for me as an investor, how should I read that and watch? How does that impact me?
Yeah, so it's a good question. I mean, the debt brake, or as they call it, the Schuldenbremse, which is basically, symbolically, but also, economically quite significant, is Europe's largest economy. And so this kind of, long-term, fiscal discipline they've been exercising for many years is now being shifted. And that, I think, signals I would say, broader acceptance of kind of what we can call counter-cyclical fiscal policy, across the entire bloc. And it creates also political room for other, EU countries or members to pursue, similar, I would say, more expansive, fiscal strategies without, facing necessarily the same kind of market, or institutional scrutiny. And that could actually be marking a turning point in the kind of EU economic, growth governance, especially if Germany kind of permanently redefines that kind of break.
Absolutely. Do you see that other countries in Europe could go the same path and also ease and also start to spend more? We've had the summit of NATO here. They decided they would now go and invest 5% of GDP. Is that something that we just see more as a blanket rather than Germany just by itself?
Listen, absolutely. I think it is possible. I think other countries can follow suit, especially if Germany continues to kind of lead by example. However, a lot of them already face elevated, debt to GDP ratios. Interestingly, I think the fiscal discipline, which has been put in place, since 2011 and kind of the PIGS crisis, as we can say, has helped a lot of the southern countries, which when you look at the growth and economic revival which has happened in the south is quite impressive. But that market tolerance varies quite significantly across member states. So it's the ECB's credibility and kind of subdued inflation expectations which have so far kept also this yield in check. And so your question whether it's risk of a sharp rise in yields and grows if fiscal expansion is not kept in check, so to speak. Yes, there is a risk, but the thing is also today, people don't realize this, but the ECB has this instrument called, the DPI, this transmission, protection instrument, and that can really act as a backstop. So I don't see, that these kind of what you call, more precarious fiscal positions would necessarily, be a risk. So absolutely, I think with what Germany is doing and what you've read also, in the press recently, can definitely have a ripple effect for other countries to follow suit.
And then, thank you, Marc. Then, when you think from a political side, one of the struggles I always find with Europe is it's so fragmented, right? You have smaller countries, you have various languages, etc., barriers of entries here and there. Would that increased fiscal spending also potentially lead into a greater integration in the EU? Or do you see that the populist movements that we see everywhere would actually pull things out, or rather than getting together, more breaking apart, or not, at least not getting closer?
Yeah, listen, I mean, it's a subject we had for many years, right? It's like, well, Europe, is it really one country? And yes, we have a monetary union, and we try to have a trade union, which has been working quite well. Militarily, we're not quite there yet. That might also change. But then it's fiscal union, and all, I would say, increased, dependency on one another, especially if it's channeled through kind of EU level programs. There's been kind of this, recovery and resilience facility, which could actually deepen integration. So particularly around topics like defense, energy, industrial policy, and so forth. So I think that's absolutely doable. I think, however, that integration will remain uneven and politically contested, mainly because of sovereignty, right? And that's very deeply ingrained into European minds. You've seen, populist movements, which, had significant sway in a number of European countries. And so there's a lot of skepticism going on, of Brussels, which limits kind of the EU ability to institutionalize, those fiscal rules or joint borrowing instruments. I remember back in the day, I was still a trader, back in 2008, when there was a European crisis. We're always talking about this Eurobond, right? And which would solve so many issues. And I still believe that, but that path to kind of deeper integration is more likely to evolve, pragmatically, around specific needs. As, like I mentioned, topics like defense, which we believe is a big topic and a very interesting one, by the way, for investors to look at more specifically, or green tech, rather than kind of, treaty changes or others.
Very interesting, thanks. I could go along and have several more questions, but maybe let's get to the key question. When you think of the shift that we have seen, where investors globally have shifted somewhat more funds from US into Europe over the past 1 or 2 quarters, is that a trend that you think is durable, or may even be accelerating?
Yeah, listen, I think that shift, kind of from US to Europe, I think this is here to stay. What's interesting is there was a time where you always had to say, well, don't underestimate the US, never be underinvested, into the US, because it's always been outperforming, even when you kind of adjust for currency, swings and so forth. And that's correct. US is kind of the innovation market par excellence, followed very closely by Switzerland, which people always, tend to forget. But I think the rotation to Europe is driven by, a multiple of converging forces. So you have, first of all, these valuation gaps. So European equities, whether it's on the public side, but also the private side, and we have a number of slides we can also show you later, they remain cheaper relative to US peers. And so that is definitely a driver which is here to stay, and it's going to take some time, to do that catch up. Then you have monetary divergence. The ECB, is beginning to cut rates much sooner than the Fed. You see the Swiss, who are always kind of leader, we're back to zero here. Europeans, might actually, follow suit very, very, very quickly, as we're more in a long-term deflationary mode. And by the way, that's the case for the world, and we tend to forget about what we call short-term inflationary pressures. And short-term, it always depends, what that means. It can be multi-year, but that's still short-term on a 50-year basis. So that's more attractive on a relative basis. And then you have a lot of kind of what we call industrial, policy tailwinds. So the EU fiscal spending, which we just mentioned on a number of topics such as green energy, digital infrastructure, defense, which are really catalyzing these new, what we can call growth pockets. And then there's the reshoring and diversification. So global investors are seeking alternatives to the US tech concentration. Today, obviously, you're forced to invest in technology, but that is a risk as well. And I think Europe offers exposure to a lot of differentiated sectors: manufacturing, healthcare, industrial leaders, great companies, right? With actually very healthy balance sheets. So I think when you look at all that, plus I would say political risk hedging, if I may say so. So we've seen US political volatility. Adrian talked about it, ahead of already the last year's election, and now again. And I think that's prompting a lot of capital to shift to kind of perceived geopolitical safe havens. And as much people might laugh when I say this, I think Europe can have that. So we believe a lot in what we call the mega trend rather than the MAGA trend, which is making Europe great again. And I think that's very valid.
Yeah, absolutely fantastic. Look, why don't we go and dig a bit deeper in terms of the valuation? I believe you've prepared a slide there, Marc. If you could perhaps go on. The slide 6 shows the valuation gap, right?
Yeah, what is interesting here, I mean, we've talked about this. I mean, private equity obviously is still remains, I think, a significant, contributor to long-term performance. We've tried to show a little bit here, how Europe PE funds have performed when we adjust for, private market adjustments for public equities, whether it is, worldwide. So here we've done the MSCI, world, but also the MSCI Europe. So it just shows you that you have, some of that outperformance, which is a lot driven, by the way, because of valuation. So on the next slide, we have that actually, which is quite interesting. So you see that the kind of average EV to EBITDA multiples for private companies in Europe, they trade at about 30% discount. Very similar to what is actually happening on the public markets as well. So it really offers a compelling kind of market for value-driven investors. And then there's also a lot less competition, right? Then you have about 3 times less competition than in the US. And Europe, is probably the second most, mature market behind the US, but just offers way less competition than that market. And with those kind of high barriers to entry, yes, people often complain, say, but it's a linguistic nightmare, and there's cultural challenges to be invested in different countries. But people do forget that we do have a trade union, and that's facilitated. So you do have I would say multi-country conglomerates which work extremely well in Europe.
Now, before we already mentioned the sort of crowded trades, right? That we try to avoid. I believe you try to avoid. But where exactly, or what are your key niches where you think you find value at the moment?
Yeah, it's a good question. Maybe if we slip to the next page. What's interesting here, you see the kind of the lower mid market, has outperformed large cap, over several decades now, and it just offers, better risk-adjusted return. So we believe that's the case, in the public market, but even more so on the private side. And there's a number of reasons to that. Well, one is you even have lower valuations than just big companies, so you have that kind of, discount for going into small companies. There's a lot more operational value creation, over leverage. So a lot of big, PE funds, but even public companies use a lot of leverage to get to what they need to. That's not necessarily the case here, and you have just more operational leverage as well. The penetration, much less penetration, of private capital, into this, what we call the lower mid market than compared to large caps. We have some really interesting data we'll show you in a second, and then a much broader exit universe as well, right? So when you actually think of exiting, people always say, it's difficult to enter these small companies, but as they grow, very minimally, you have a much bigger universe of buyers, from private equity, strategics, conglomerates, foreign investors, et cetera, et cetera. And then at the end, the multiple expansion, which we never, take into consideration, but you almost always have a multiple expansion, a couple of years down the road, not only because the companies are larger, but what we're seeing more and more is also Americans, coming to Europe and buying European companies. There was just a Bloomberg article recently about suddenly, Blackstone coming and wanting to spend 500 billion, in Europe. Where are they going to buy that from, right? And they're buying that, by the way, at multiples which they're used to. So they're comparing, and we've seen this so many times where we own, European companies, and we have American infrastructure funds or conglomerates who come and they pay us these, crazy multiples. Or at one point, we also go with our investment committee and say, well, we would have kept that company for another, 2 years, 3 years. But since they're already paying, that huge multiple arbitrage, we should sell it. But that's a little bit where we see the opportunities.
I believe when we go, I think the next slide is one that also shows a bit the resilience, right? That Europe actually really has a lot going for it.
Yeah, 100%. People often think, but invest in small companies, there's more risk to it, etc. But and more volatility. Well, actually, no. If you look at the large cap market, has proven to be a lot more volatile than smaller companies. So because of the higher interest rate sensitivity, some of these companies are very highly leveraged, right? And we've seen what's happened in the last couple of years with interest rates. Smaller exit universe, what I was mentioning before, if you're already a very large company, and you need to exit. I mean, if today, you're a large luxury company or consumer goods company in Europe and you need to exit, there's not that many buyers, right? In the US, you'll have, big companies buying other big companies. Today, if you're a multi-billion-dollar company, when I say multi-billion, it's anywhere from kind of 10 to 50, nobody's going to buy you in Europe. You need to go to the Americans. You need to go, abroad to actually find buyers. So that's a little bit the issue. Whereas in Europe, you have so many more companies, in the SME space. So it's much more attractive to say you go into that kind of small, medium cap enterprises, basically do the value creation and then sell to a much broader universe. So you have lower entry valuations, which creates this kind of stability, less leverage, which they usually take. And what's also interesting, you have this great supportive banking environment, which is also one of the reasons why these are less crowded trade, is because historically the banking sector in Europe has been actually strong, much stronger than the US. And you saw it in 2008, who's been kind of financing, you could call it the Mittelstand or the SME space in Europe.
When you look at the space and you think of the various buckets of larger, medium-sized, small-sized, who is attracting funding and where do opportunities really crystallize?
Yeah, that's a very good question. So on the next slide, we have actually something addressing that, which is showing you a little bit, the amount of capital raised and where it's allocated. So you see that kind of the large funds, they control the majority of private equity capital. Unfortunately, what's crazy is when you look at all the number of funds raised, they all compete for the same deals. So you have kind of 99% on the far right of EU companies, which are SMEs, right? Which basically nobody competes for, or a very smaller amount of what we call lower mid-market funds. And then the big funds, where most of the capital is raised, if not all, they compete for 1% of the universe. And that's exactly the issue we've seen. And that's a phenomenon in Europe, but it's a global phenomenon. And one of the main drivers of why, these risk-adjusted returns have come down, because you had larger and larger funds, which, 30, 40 years ago were much smaller. So when, KKR, Carlyle, Blackstone, were created, they were looking at companies where there was less competition and driving those returns. And they've almost been a bit of a victim of their own success, right? Where now they're all competing for the same deals. Most of the returns are driven by, financial engineering. And that's definitely not the space you want to be in. So this is what Europe really offers. Where the US, yes, you have an interesting SME space. The problem is it's way more competitive than it is in Europe, and valuations also trade, at a much higher valuation.
Great. And I believe then, I suppose personally, but through the firm and for your clients, your key ambition is really to find that little nugget or that pearl, where you have the right risk reward, the upside, and everything there, right? Tell us a little bit about that part. What are you trying to find for your clients?
Yeah, thanks for that, Mark. Maybe if we flip to the next slide, it gives you a little bit of a flavor of what we're trying to do. But we always tell ourselves, we're small enough. And when I say small enough, even if you're just a couple of billion, you're small enough to be able to look at a variety of opportunities, and I consider that a luxury. So I think all of us here on the call today, we're lucky to be able to look at a much broader universe of opportunities. And so because we are, performance driven, we invest our own capital, we have, a lot of skin in the game. We look for, these hidden gems, right? And so we stay away from what today are great brand names, and they solve a very different issue, which is, how to allocate large sums of capital and not lose too much, which are asset gatherers, but which cannot generate, the performance they used to, for all the reasons we mentioned. So what we really look for is very selective, investments. We look at things which are uncorrelated. And so in the PE, when you say, well, how can I continue to be uncorrelated? We look for things which are not cyclical. So defensive industries, whether it's in logistics, healthcare services, business IT services, which are not directly connected to the end consumer, to kind of weather any kind of macroeconomic shocks or cyclicality, and then things which are very well run. So family enterprises with high cash flows. There's a lot of these businesses. Even you look through 2008, or you look through COVID times or hard times. These firms have grown, right? Of course, they're not necessarily sexy, and it's not the next Nvidia. But we own so many companies which are doing 40 to 50, 60% cash equity yields, right? Which you could almost hold forever and just kind of dividend recap them every couple of years, and that are really, I think, some of the opportunities we look for.
Brilliant. Time is running very fast. Thanks, Marc. Dear audience, this is your moment. We go over into Q&A. We already have 2-3 questions. We'll dive right into that. If you have questions, do please pop them now via the chat function. And Marc, if I may, the initial question for you, we've spoken about alternative investments. We've spoken about private equity in particular. For somebody that's somewhat more risk conscious or has a low risk tolerance, is private debt an alternative? Something that just has perhaps less drawdown, or how do you see the sector of private debt?
Yeah, very, very good question. And listen, not to quote Warren Buffett, who's an incredible investor. And by the way, if you look at the return of Berkshire Hathaway, they've done about 14% annualized over the same time period. So just a little bit better than Yale over the last 20 years. He always said, it's not by diversifying or looking at other segments that basically you're managing risk. Risk is usually something when if you don't know what you're doing, well, that's taking an actual risk. So what's interesting to your question about private debt. So yes, you can argue that if you're looking at the debt side, it might be less risky than on the equity side. The reality is that today private debt, especially on the large cap segment, the returns are very limited. So if I compare that to the actual equity risk, I'm not quite sure it's worth it. Except if yields continue to go back to negative territory, there might be an argument there. But if I compare, for example, in our space, in the SME space or lower mid-market space, the problem is twofold. One is, well, if those companies go bankrupt, whether you're in the equity or the private debt side, there's almost no recoverability. So you're better off actually making the equity bet because the risk returns are better. Second issue you're also seeing is the returns have come down quite significantly, even on the SME space, on the private debt side. Why? Is because there's been so many people and so many new funds on the private debt side who have come to market. So in the last couple of years, we've seen so many people coming into the space, new actors, because of the hunt for yield, which was largely driven by the low interest rates and has continued as rates has increased. And then you see a lot of accidents, right? I mean, the most notable one is obviously Benko, which I think you've all read in the press, and how badly that can go. So we actually think, as much as we see it can be attractive, at first hand, you're actually better off taking the equity side. We do some private debt at Seeds Capital, but not on the corporate side, but in other segment. I think if you're ready to take corporate risk in the small mid-cap space, you're better off doing that on the equity.
Okay, thanks a lot, Marcus. That's greatly appreciated. Then maybe a question for Adrian. Adrian, you've mentioned Section 899 from the US side in the big, beautiful bill. Tell us a little bit more, give us a little bit more meat on the bone of how that matters and how this could play out against me as an investor. Adrian? I hope Adrian is still with us. Adrian, can you hear us? Okay, let me in the meantime just answer one more question myself, and then we pop the question again to Adrian. We try to hopefully he's right back. One of the questions that was asked by the audience was, since interest rates in Switzerland are so low again or at zero, would it make sense to borrow Swiss francs to do investments globally? Now, I can only share my personal view and opinion. Most people who have borrowed Swiss francs have done so because of interest rate differential, where they say, oh yeah, it's a cheap way to finance. Swiss franc, generally speaking, in my book, is the most expensive currency to borrow in, as long as you don't borrow Swiss franc for Swiss franc investments. And generally speaking, for global investors, it's quite hard to find Swiss franc investments. So if my mortgage is Swiss francs and I basically pay almost nothing, and my tenant pays me something, that's a good trade. That makes sense. If an international investor borrows Swiss francs in order to finance a US dollar-based portfolio, that's a very risky strategy, right? So be very careful. If this is proposed to you at any point, please, as a reminder, just give us a quick call and we'll show you a few examples of how things went wrong. So don't borrow Swiss francs before you have spoken to us, please. Now we'll check again. Adrian, are you back on? Okay, then if not, sorry for that. I'll get back on Article 899 in the summary. I would like to thank Adrian and Marc for their fantastic presentation and the great conversation. It's been amazing to have you. Dear audience, for me and my colleagues at Probus Pleion, thank you for joining us today. We greatly appreciate your presence. We're looking forward to add more value and answer your questions personally. Probus Pleion Group, large enough to matter, small enough to care. Thank you so much and have a good day. Bye for now.
Thank you, Marc. Nice to see you, Adrian. Take care, everybody.
Bye-bye.